Hey, hey, it's Dr. J. And guess what? It's the best day of the week, Tuesday. Because on Tuesday, we get some really superstars in my world and they come along and share their gold. We always invite you along to come and ask your questions. Sometimes you're busy, but yeah, I'm sure you'll watch the replays. And none other than Jackson, Millan, the wealth coach and guru, he comes on every second Tuesday and shares some of the good stuff in making sure that when you make more sales, you're going to be able to then invest it to then create wealth. We're part of the solution. We'll teach you the processes and make sure you get the soft skills. But, you know, working hard and making lots of money is never going to give you the freedom to have those choices. So I just bring the great man on, and gee whiz, I say the last 3 sessions have been invaluable and the feedback's been outstanding. So Jackson, thanks for joining us today.
Good to be back here, mate. I'm out of the bush. I survived, and we're back to civilization.
Oh, well, it's I must say, I was talking to a good friend of mine the other day, and we were talking about connecting out in the bush, and really, it was really a conversation about being around things that are alive, everything around you being alive, and it's a nice little segue into actually making sure that when we're working hard and making tons of sales and having a successful business, but we've got to have the ability to have a life, and you know, in the economy that we live in, and the type of things we want, we need to make money. And sometimes they say it's a dirty word, or selling's a dirty word, but the consequences of not having it, you know, you can be happy, but I know I haven't had it, and I have had it. And I can assure you life is a little easier for yourself and your family when you got it, but it's not easy to establish all those criteria which have the success. There's lots of ways to lose the money. And today I want to talk about a lovely process you explained to me a little while ago, and it really resonated with me, and I shared it with lots of people about what you taught me. And it's the 3 bucket process. It's a system you created to make sure that people understand how to create let's say, a timeline of wealth. Now, the big thing about wealth creation, and when I talk to sales professionals, business owners, they get incredibly overwhelmed about all the things they need to learn and do. So why do people get so overwhelmed in this wealth creation model where they all want it and they all want to dabble in it, but they get overwhelmed, and guess what overwhelmed does? It just means you get rigor mortis and nothing happens. Well, why does that happen?
Yeah, exactly right, mate. I think the biggest problem is really 3 key things. In our system that we created, it's called the Wealth Mastery Machine, we identified that there's 3 common problems for most people. The first problem is they don't have a plan. And when you don't have a plan, it can sometimes be exciting, and the thrill of just working things out as you go is sometimes romantic, and some people just use it as an excuse to not create a plan. But the issue is that it means that we can't actually simplify the short list of strategies and things that are going to get us where we need to go. Because if we don't know the destination, we don't know what path to take. The second problem is that we don't have enough cash. There's not enough cash available for us to execute on the strategy, to be able to build the muscle memory through repetition to turn something that we learn into a habit and a long-term behavior. And that leads us to the third problem, that we don't have enough consistency. That we're on the roller coaster ride of sales, the roller coaster ride of life, and maybe the roller coaster ride of cash flow. And we cannot deploy the strategies often enough and frequently enough to be able to get the results that we want. And it's typically these 3 problems that get in the way of most people getting on the right path for financial freedom.
So it's with people that are in sales and have a business. I mean, sales is the highest paid hard work in the world if you're getting conversions.
Yep.
And if you have a business, you can actually then leverage some other things as well. But if you're in sales, so we've got some people that are professional salespeople. If they work hard, and I keep telling people, you've got to do more these days. Sure, work smart, but you've got to learn and do more to get the activity. If they have the plan. I think that's first. Then they get the cash, and then they need to have direction. The problem here is once they've worked hard and they think that that's going to make them the money, they get into overwhelm. Well, what should I do? Should I buy a property? Oh, I haven't got enough. Should I get into shares? Gee whiz, my friend just lost a whole lot of dough, but they don't understand when they sell it, that's when they lose it. But they've got the wrong stuff, or they go into Bitcoin and stuff, and all of a sudden the whole world caves in, and they say, oh, I'm trying all this stuff. And then they just do nothing. I can relate to that because, I've made some big mistakes and I stuck it in the bank. I know it's safe, and then it doesn't make any money. So you're between a rock and a hard place. So if people get a bit of success in property, for instance, should they just have one investment strategy, or does there need to be diversity?
Really great question, mate. So I think most people find themselves in a couple of positions, right? They're either haven't got into investing yet, or they've maybe been out of the market for a while and they're a little bit gun shy, right? That they don't want to make a mistake. They don't want to lose money. And this is something that often leads people to just sitting on the fence and waiting to see what happens. Like, we've had many people that have come to us over the last decade have been talking about the property market crashing. They're waiting for the crash. They're waiting for the crash. They're waiting for the crash. And it's through their inaction that they've lost hundreds of thousands, in some cases, millions of dollars of opportunity cost. But then we also see other people who have a strategy that's worked, and they're continuing to rinse and repeat that strategy over and over and over and over again, thinking that it's going to continue to work to the same effect. And this is something that I wrote about in my book, and it's a little bit cheeky. I hope you don't mind me going in a little bit of a different direction with this one, Steve.
Go for it. Your segues are fantastic.
So I relate this back to a relationship, right? You're in a new relationship. You're getting to know each other, right? You're getting to understand what your turn-ons and turn-offs are, right? And with your new partner, you've started to understand what makes them tick. And you go, I understand the moves. You've got the moves that work, the moves that get the outcome, if you know what I'm saying. But after a while, you're continuing to rely on those moves because you know they work. But what happens? They start to lose their effect. And you start to wonder what's wrong. And the exactly same thing happens on your wealth journey. Now, as human beings, when we find something that works, we are inclined to continue to rinse and repeat those strategies, expecting that it's going to get the same result, but it's not necessarily the case. And this is the reason why we developed the bucket strategy, because it provides us with an objective framework to ensure that we're not just expecting the same old strategy to be rinsed and repeat to the same effect, that we have an objective framework whereby we have the ability to review an investment against its ability to help us achieve an outcome.
Because things change, don't they, Jax?
100%.
It's evolving. I mean, if you thought about a year ago of what's working, what's not, there's opportunity aplenty right now, but not. It's all underneath the rocks and underneath the moss. Exactly. And unless we've got that process in place. Now, I'm glad you brought that up. A lot of the guys and the girls out there that are listening to this won't know what the bucket strategy is. They go, what's he doing? Is he Jack and Jill? What is the bucket strategy?
The bucket strategy is basically a three-tiered strategy when it comes to allocating your wealth. And it is a strategy that can be shifted and changed depending on your life stage. So typically speaking, your bucket strategy will have two main iterations. It will have an iteration while you're in the accumulation phase, where you are working, you're actively producing income, and you have surplus that you can actually be building your wealth with. And the second stage is the drawdown phase, or the annuity phase, whereby you've got to a point where you've either reduced your working hours or you have stopped work completely, and you are now reliant on your wealth to be able to provide for your lifestyle. Now, we have three buckets. We have our short-term bucket, which is basically anything that you need to fund in the next 12 months, typically lifestyle goals. We have our medium-term bucket, which is our bucket that is planning for anything from 1 year until 10 years plus. And then we have our long-term bucket, which is 10 years or more in the future. Now, what we need to work out firstly is what are our goals? And there is an exercise we spoke about a few weeks ago around actually understanding what are you working towards? What are your goals, dreams, and aspirations? And we need to map out all of those things first, because one of the biggest problems that people have is that they just accumulate wealth aimlessly. We don't know the destination. Once we know all of our goals, we know that we want to go on a holiday, hopefully when this COVID thing's over the next 12 months. We want to have a good emergency fund just in case something happens. We want to make sure we build a deposit to buy our dream home in 5 years' time. We know that we want to retire at age 60 with 80 grand a year in passive income, and we want to be debt free. We can segment all of those goals into the buckets, some in the short term, some in the medium term, some in the long term.
It's interesting you bring that up. We're talking about the future, and you mentioned an emergency fund. So when you actually have these buckets, you actually say, well, this is what I need to pay for. But I would suggest that in that conversation, there's going to be a little bit of savings for a rainy day or a COVID year or so forth. And then you can actually go into the next bucket when you've got a little bit of peace of mind and have the ability to leverage that money. Now, if you've got a young person, a 10-year span works well. But I know a lot of people that we work with are, in their 40s, sometimes 50s, 60s maybe. And they've sat on that stuff, like you said, and they say the rigor mortis set in, and all of a sudden they say, well, I've still got about at least a good 5 to 10 years that I can play with. If it's a little shorter, can the short, medium, and long-term strategy still work?
Definitely works. We just need to adjust the allocations of what needs to go into each of the buckets. And this is where most people get this wrong. Most of us are so focused on that long-term bucket if we start building wealth because of that fear that we're losing ground. We're falling behind. And typically it means that we're overemphasizing that long-term bucket. We're putting all of this money into these high-risk investments that are volatile. And we leave our short and medium-term bucket with hardly anything in them. And the risk is that when these short-term things come up, that we have to crystallize some of these investments that we thought we'd be able to hold for the long term, and either crystallize losses or miss out on the long-term opportunity just because we didn't allow enough time for them to get the real results that we wanted. So when we talk about this strategy for our clients, we firstly look to work out, what do we need to fill in that short-term bucket to give us peace of mind and certainty around that next 12 months? Then, what about the medium-term bucket? What are the things we want to achieve within 1 to 10 years? And then the 10-year plus.
Can you do the first bucket with the getting that peace of mind and have the second bucket working in parallel, or is it sequential?
Definitely. We want to make sure that we've got a certain level of emergency fund in our short-term bucket, because that's typically what's going to hit us for a 6 and bring the strategy to a grinding halt. So the big question for everyone is, what is the least amount of money that you need to have available in cash or easily accessible funds at all times? Maybe you're the primary breadwinner. And if you lost your job or business wasn't doing too well, that things would come to a grinding halt. Maybe you've got parents overseas who are getting a little bit sick and you might need to travel at the drop of a hat. Maybe you've got an old car that is prone to breaking down. We need to ask ourselves those questions and work out what is that least amount of money in cash that we need to have. And in our experience working with thousands of clients, that number is typically between $10,000 and $20,000.
Well, that's good to know. Is it 10 to 20K? Is it? I love what you're saying, because there's things that everyone says, gee whiz, I should think of that. But unless someone asks you those questions, you don't really search for the answers. You'll just pull it out of your ears. And you need an expert, or I would say not an expert, but someone coaching you to be able to ascertain what those things are that we all know are around, but we don't come front of mind and we just let them go. So with that in mind, how important is it to understand the fundamentals of those buckets? Because, they might understand it, but they probably need to be adjusted quite regularly. Just
Definitely.
To, gee whiz, have you reduced your costs? Have the costs gone up? Well, gee, that first bucket's got to change. Or gee whiz, what's your 1 to 10? What are we doing to create something in perpetuity in the future, whether it's shares or portfolios or property? So how important is it to get those fundamentals? Because again, they'll go into overwhelm and all of a sudden it becomes difficult.
Exactly. Let me give you an example. I have a client that I've been working with for about the last 12 months, and we've been working towards helping them buy their first home. Now, they were migrants to Australia, didn't understand the system, had only been here for a couple of years, and essentially everything was foreign to them. Now, by teaching them these fundamentals, recently I had an email from one of them where we're on the cusp of buying the property. We've got the pre-approval in place, they're searching. And he sent me an email that was something as follows. Jackson, I found a property. It's a little bit out of our original price range. And I understand that it's going to require me to allocate more of my emergency fund in my short-term bucket to buy this property. And I understand that we're going to be at a little bit extra risk for a period of time. But I've looked at our surplus already, And I know that we're going to be saving about $3,000 a month every month thereafter once we've bought the property. So we should have the emergency fund back to where it needs to be within 3 to 4 months' time. So do you think that that's a measurable risk that we could take? Now, because he understood the mechanics, that he understood the strategy, he understood the impact, and he was able to identify a solution, then he basically created a solution for himself because he understood the system.
That's because he's been coached, though. Is that right? He's been coached.
Exactly.
You wouldn't read that in a book. I mean,
No.
you wouldn't understand the mumbo jumbo in a lot of those books, which with the best of intention, but they need coaching in that sort of stuff.
Exactly. He understood the system so he could work out the parameters, the pros and cons for himself. And that's what people need, because how many times have you been in a situation where you were just overwhelmed by the options?
I mean, I know when if I actually learned something, but it's always good to ring up somebody and say, like that he did with you, is obviously one of your clients, but he then said, do you think it's good? And I've learned this, have I got it right? And you say, nah, or yes. And that gives them a bit of peace of mind to then go through and have the plan in place, because you created the plan from the get-go. This is gold, because gets rid of overwhelm, but it does need to spend a little bit of time to learn how to do this. Is that right?
100%. And look, it's one of these things that it's through repetition. We need to get that repetition. This is where the consistency comes into play, because if we create this wealth mastery machine, we've got this system, this operating system for our money that allows us to turn our business profits or our commissions from all of our sales into personal wealth that we can do each and every single month without fail, even if it's just a small amount of money. It's building that money muscle memory. And it's so important to make sure that when push comes to shove, when we're in difficult situations, that we can rely on an objective system to make informed and educated decisions like this client. Because on the flip side, I've had new prospects that have reached out to us who've been in a pickle. They've made an emotional financial decision, a knee-jerk decision that they didn't have a system in place. They just thought it was a good idea. Maybe they saw a property and they liked the red front door and the new whiz-bang kitchen, and they overextended themselves.
So this is very different from going to, how can we say, a financial advisor, so to speak. So a financial advisor, you go there, they tell you all your little things that you want, and they'll say, well, we'll create a portfolio for you, and they sort of manage it for you. It's not creating any muscle memory, because you're really at the beck and call of what they do, and they usually just set and forget, and they'll put it in blue chip stuff, and you'll get a return, you'll lose, and sometimes, but it's not creating a learning. So what you're saying is a little different, I'm hearing, is that you've got to learn those fundamentals, like you said, have the plan, know the cash flow, but have the repetition in being taught how to do it. Because if you're not doing it yourself and relying on someone else, you're not going to know what to do if something changes. Is that right?
Exactly. And look, the perfect analogy here is that for many financial advisors who are wealth managers that manage portfolios, you might have to have $500,000 before they'll even look at you. Whereas for many of our clients, we've got clients who have come to us with $0 in the bank, or in some cases negative dollars. But it's still applicable to them because we give them the tools, the framework, the operating systems for them to be able to get them out of the situation that they're in, if it's in a bad situation, or to actually know what decisions they need to be making to get themselves in the position where they've got the $500,000 of funds under management.
Can I ask you a big question?
Sure, mate.
Is that difficult to do?
No.
Because I know lots of people going to say, wow, that sounds great, Jackson. You know, I haven't got the time. I'm not really good with numbers. And, you know, I just find some people just get scared because they don't know. They've made so many mistakes in the past. But again, it comes back to, you don't go to an advisor that just says, I'm going to put it in there. You need to have a way to actually learn it and just know the fundamentals, and then work
Correct.
with someone, I'm hearing.
Exactly. And look, the question that we ask for any new prospect that comes in, do you have 2 to 3 hours a week to take action for at least the first couple of months?
And if they have zero in the bank, and you can actually fix that problem, get them out of debt, and then they can start creating some stuff. So anybody can qualify if they're prepared to put a little bit of money aside and also have a plan, but spend a couple of hours. It's like gardening. If you don't weed the garden, it's going to overgrow.
100%. And look, we had a client recently, a new prospect that came in. We took him through the process. And by the end of the process, we had the conversation and said, hey, do you actually have the time to allocate to this? And he said, I love the system. I love everything you do, but I just don't have the time right now.
Isn't that crazy? Everyone has 24 hours in a day. It's what's your priority? I mean,
Exactly.
put it in perspective, Buster.
Exactly. But if you don't have the time, you're not going to get the results. So we need to develop that muscle memory. We need to invest the time in creating the plan. We need to invest the time in making sure that we maximize the cash. And then we need to invest the time in creating the consistency, that money muscle memory that's going to get you the repetitions you need to get your own expertise and to be able to turn these things into habits and behaviors. And the bucket strategy is a really simple way for us to then allocate that systematically to take a lot of the emotion out of it.
Great. Well, look, we've got a clear understanding of why people get overwhelmed. We understand that there's having one little way of investing is thwarted with danger, and also it's important to have some type of bucket system with a plan, with the cash flow and what to do with it. So and it's critical to create muscle memory so you know what to do, especially if things change. Now, Darren, have you got any questions for Jackson at this point of time?
Yeah, certainly, Jackson. It rings true. I've certainly been in that position, had the long-term plan, saw a short-term opportunity, and if it doesn't go right, it takes years and years to redo that long-term plan. So totally here. You talk about the money muscle memory, and it refers to a mentor that I listen to every morning. And yesterday they talked about happiness, and I'll quote him, he says, the psychologists show that we are happiest when we see the evidence of our progress. So we see the evidence of our progress. So you're saying with the 3 buckets, it's not about the end result necessarily, but it's every day just seeing that you're contributing and you're moving towards that. And for him, that reflects that happiness. So how do you determine what percentage of each of those 3 buckets we put into? How does that come about?
Yeah, definitely. I mean, that's so important. We've had clients that have come to us that have just been paralyzed by fear. And we start this investment strategy with sometimes $200 a month. And $200 a month, like, question to all of you, like, do you think that you could carve out $200 a month?
Just get rid of a couple of lunches and lattes, mate. That'll be all good.
Exactly. And it just starts the process. And you see the light ignite in their eyes, the fire comes back and they get excited again. Even though it's a small amount of money, they're feeling that progress. Now, in terms of how we allocate, this comes down to their goals and what actually fits in those buckets. So for example, I've had clients come to us and they say, hey, I've got all of this money sitting in cash. What should I do with it? Should I invest it in the share market? Should I do this? Should I do that? And then when we have the conversation around the goals, and similar to what you mentioned, Darren, we actually have the conversation to say, hey, actually, there's a short-term opportunity that's coming up. Let's say, for example, they want to buy their home in 12 months' time. Then does it make sense to go and gamble that in the stock market with potential volatility of 20 to 30% in 12 months? Yeah, we might be able to make a good return, but because of the time frame is so short, the risk is amplified. So then it means that we focus on the short-term bucket. So what we look at doing is this is tailored specifically to all of our clients. And we've got some tools that allow us to actually map this out and work out exactly how much we need to have in each bucket. And then we work out what levers we can pull. Now, when it comes to building wealth for the future, there are only 4 levers that we can pull. The first lever is our initial contribution to our investments. So what do we already have sitting in the bank or on our balance sheet, our assets that we've got available, to allow us to allocate to our wealth creation strategy. The second thing is our ongoing contributions. How much can we contribute each and every single month or week or fortnight or whatever the time period might be? Third one, what is the risk that we are prepared to take along the way? Because all investments have a relative relationship between risk versus return. The more return we want, the more risk that we need to take, and vice versa. And the fourth one, is how much time are we prepared to wait? So when we can work out those levers, then it can allow us the opportunity that is available. And more importantly, what lever are we able to pull that's going to get us the most impact?
We come back down to consistency. That time factor is something that you need advice on, and someone that understands the process. Would you agree?
100%. So important. Like, for example, if we've got a goal that's anything less than 10 years in the future, the difference between an 8 and a 10% return, let's say, is going to have a very small impact in the grand scheme of things. And over the long term, compounded over 20 years, that's going to be a huge impact of an extra 2%, because compounding is a snowball and it rolls over time. So in actual fact, in the shorter term, the number one lever that we can pull is how much we contribute. It's like the famous saying goes, it is not your earned income that makes you wealthy, it's what you do with your earned income that makes you wealthy.
Yeah.
So if we're smashing our sales, hitting all of our targets and KPIs, we're rolling in the dough, then that's not going to presuppose you being wealthy. We need to allocate that effectively to make sure that we can achieve all of our goals in the short, medium, and long-term buckets.
So with that in mind then, with the change of economies and so forth, we've had significant change recently, haven't we, with economies and lots of subsidies by governments and so forth. Can anyone be successful investing by just dabbling? And when I say dabbling, I mean a little bit here in an IBD, or grab a bond because Bobby said it. Oh, look, I'll go Harvey's in a property, or gee whiz, I'll buy some coins or whatever. That's what I call dabbling, or stick it into the stock market because I thought that's going to be a speculative. I was told that's gambling. Can you actually be successful by doing the dabbles?
No. There is not going to be any one investment that you make that is going to make you wealthy. And this is one of my biggest pet hates of people who talk about playing the stock market. You cannot play the stock market. There are some of the world's best investors of all time who have lost money in the stock market. And what makes you think that you can do better than them? Is your ego that inflated that you feel that you are some prodigy of wealth creation? And look, for a very long time in my younger years, pre-beard, I was probably less wise and had a much larger ego. And I used to work with my clients to help them actively trade the market because I thought that I was that prodigy. And although we were able to get results, when I was actually able to test it and work out, the majority of it was pure luck. It really was. And therefore, since then, of helping my clients build over $1.2 billion in combined wealth, I've been able to work out that what actually drives the real performance in a portfolio is the asset allocation of how we actually deploying wealth into the right asset classes, and essentially how long we hold those investments to be able to realize the returns.
Now, this is quite fundamental what you're talking about. I'm seeing an iceberg here. I mean, there's this little bit here, say, wow, that sounds pretty cool. But I'm assuming there's this huge amount of time that's spent in years gone by when you were a young puppy before the beard and all that sort of stuff, and things that you learnt along the way that's given you the ability to see things and sometimes look at trends, but you're not going to take a risk. So I find that sometimes people said, oh, this has always worked. And from my experience in our sales process, we can continually evolve. We shorten the sales cycle, we add things to it, we take it away. And do you think keeping up to date with those things and those nuances is important? And can one person do it by themselves? From my experience, it usually needs to have different inputs, especially with wealth process, because it's so convoluted and that's underneath. You think it's really important to stay up to date with that sort of stuff? And can someone by themselves do it by themselves to stay up to date unless they do it full time?
I think here's the thing, Steve. I think that the biggest problem that most people have is that they try and treat their active income and use the same rules that they use in terms of being able to influence how much they earn in their day job. And they try to apply the same rules to their wealth creation, which is why many people fail, and particularly many entrepreneurs fail, because they're constantly trying to actively manage their wealth, and they're doing more harm than good.
Yeah, so we try to stay above the water some of the times. They're trying to go up and then it goes down again, and there's this 100%. Complete fluctuation.
So what we need to do is we need to draw a line in the sand, and I did this many years ago, where my business and my day job is my active income. It is what I can deploy my strategies and tactics to influence on a day-to-day basis. But my personal wealth is 100% passive. I have a strategy that I've created, and I turn my active income into passive wealth. Now, The only things that have worked consistently over time is good quality blue chip investments. And for all of our clients, we accumulate two main asset classes. We accumulate good quality blue chip property. These are in highly desirable areas that are always going to be highly desired, that are already built out, that are either houses, townhouses, or very low-rise boutique apartments that are not off the plan. Because, for example, northern beaches of Sydney or eastern suburbs of Sydney or inner west of Sydney, people will always want to live there. There is always going to be an increased desire of people to want to live there, and supply and demand states that if there is more demand than there is supply, then prices are going to go up. And we accumulate index or ETF-based investments that allow us to diversify across entire markets. So we don't buy BHP and Telstra and Wesfarmers. We buy the ASX 300, which is the top 300 companies in Australia, or the S&P 500, the top 500 companies in the US. Because from the sheer function of the index, it's going to reweight over time. Maybe Apple or Amazon is not going to be the top dog forever. But when that company maybe doesn't do so well, it's replaced with another in the 500. It's a constant race. Imagine that you could go down to the TAB and you could bet, let's say there was a marathon race. I don't know if you can bet on the TAB at a marathon race, but let's say you can, right? And let's assume that you could bet on the whole 500 people that were running that race, the top 500. And you could get the average of whatever those 500 people made in terms of their relevant ranks of finishing and their prizes. That's a whole lot less risk than betting on one Kenyan bloke who you think is going to be the best runner this year.
So the risk levels are lower. However, the return might be low, but it's you got to have a little bit of a balance. Sometimes lowering the risk is critical, but I don't believe. I think you're just lucky if you do that. I think you need to be up to date with those sorts of things, and correct. I think you need an expert to do that. From my experience, you can't do 100%.
It. Because once again, you might make the bet, and maybe that Kenyan runner's in the front, but when he blows a hammy and he falls out of the race, then all of your eggs are in one basket. And I'd much prefer the consistency of being able to hedge my bets, not have to worry about doing all my research of who's going to be the best performer and who's doing this and who's doing that. I'd much prefer on my active income, because that's where I can make the most impact, and then increase my contribution to my passive strategy, because the number one lever that you have in your wealth creation is how much you allocate to your buckets.
Okay, so there's that personal stuff, work hard and do your damage, or if it's it's lean time, still actually contribute, and then you can put it into something that's going to create some passive opportunity. Like we said last week, what's your assets? If you stop working, how much money would you make? So this is terrific, Jackson. I hope you guys are listening to this and writing it down, and I'm going to recommend that you have a chat with the great man and actually have a chin wag, because I know he's going to give you an opportunity. It's exclusive for us guys, so take the opportunity. Darren, you're nodding away there, and I'm sure you got a question. So what do you want to ask Jackson?
Yeah, I love the point, Jackson, of the entrepreneur managing their business, the income, and trying to manage their wealth creation as well. And sometimes that is the ego that you were talking about before. So to fix that, is it important to pay yourself first and maybe have it automated into those three buckets? How do we overcome that?
Correct. Yeah. I think I find that entrepreneurs particularly fall into one or two traps. One, they accumulate heaps of this cash because they just don't have the time to actually allocate it all. And obviously right now, with interest rates being at historical lows, it's not doing anything for them. I had clients come to me with $1 million in multi-million dollars just sitting in cash just for that sheer reason that they just can't carve out the time of their business to do anything. And on the flip side, there's other entrepreneurs who try and overcompensate. They feel like they're missing out, so they're rushing. They're trying to do developments. They're trying to do these sexy and sophisticated strategies, and they end up, in some cases, risking it all. I've had many clients that have been completely wiped out because they have not considered the nature of risk versus return when it comes to their personal wealth. So what we typically do is we set an annual game plan for those clients. So say, hey, Darren, let's work out, what are we trying to achieve? What's going to help us really push the needle forwards in your 20-year roadmap for you to achieve everything you want over the course of the next 20 years? We break that down into a yearly action plan. So we say, okay, Darren, we need to buy a property this year. We need to make sure that we're contributing $2,000 a month to your investment portfolio. That's automatic on direct debit. And we're going to aim to buy that property in January. So let's get the pre-approval sorted in October. Get you ready. Then when we get to October, every quarter we'll review it. Hey, actually, you've smashed your sales targets. Profit's looking fantastic. Maybe we can increase that contribution from $2,000 a month to $3,000 a month. Hey, maybe we can, instead of buying a property at 700 grand, maybe we can buy one at 900. Beautiful. Year's done. How did we do? What's the reflection? What did we do well? What could we have done better? And then how do we course correct for the next year? It is the forward-facing plan that when Uncle Bill at the next family barbecue starts talking to you about Bitcoin, Bitcoin's not in my plan. It's not on my roadmap. We've already worked out the least amount of risk that you need to take to achieve the outcomes that are important to you. So why do we need to dictate from the course? You already have complete peace of mind and certainty that the outcome will be achieved with the plan that we've already set. No need to compensate.
Terrific. Great question. And all right, big question at the end. How can we avoid making the mistakes of not only having enough buckets, not knowing how to actually allocate that money for our personal and then having that passive? How can we avoid that problem? I mean, to read a good book, is there a webinar? And I just feel that that's just entertainment these days.
You got to get a plan, guys. And once again, if you're watching these sessions, you're learning more about wealth and money. That's all well and good, but it's not going to create the plan for you. You need to make sure that you invest the time in architecting the roadmap. Because as I just mentioned to Darren, when we've got that roadmap in place, it allows us to make objective and informed decisions around whether something's going to advance our position to achieve the goal or potentially detract from that goal.
So to get that map, and I know we spoke about this last time, can we still have access to those like those videos for the people to have a look at?
Yep.
And have a quick look at those things, and then possibly have a link to maybe have that conversation with you? Because guys, I'm going to throw this out to you. I'm a big advocate of actually going to experts for advice, and I haven't met anybody as down to earth and really knows his stuff as Jackson and his team. Listen to these videos. They're outstanding. Goes through these things in a little bit more depth, but there's also an opportunity to have a conversation. Now, conversation just takes a bit of time. If you're really serious about making a change, and it's everything happens because of a decision you make. They're called moments of impact. Fancy that. So I'm going to recommend that you have a look at these videos. Can we still have those links, mate?
Please, mate. 100%.
Terrific. And have a look at these videos. Have a think about it, and then click the button and book a discovery call. Find out a little bit about where your circumstances are, and then maybe discuss the plan that you have and see if it's flawed. Would that be okay, mate?
Definitely. And we can do it in a couple of ways. We can either jump on a call, we'll help you map out a game plan, give you clarity around exactly what you need to do. When we go through these conversations, most people are blown away because they've never just made the time to have these hard conversations, be asked the right questions, to be able to actually think about what they really want and why. Or alternatively, maybe you don't want to jump on a call. Maybe you just want to slide into a conversation on Messenger, have a bit of a conversation where we can just shoot messages backwards and forwards. I can ask you the same questions. You can do it while you're in between calls, when you're sitting on the bus, whatever you want to do. And we can still help you achieve exactly the same outcome. It's about being able to have somebody facilitate your own discovery of what you want, so then we can work out how we get you there.
Okay, you're a diplomat at all times, man. I'm going to be straight to the point. If your focus creates genius, guys, spend the time for a little bit of time with Jackson or his team to talk about it. Put the phone down, turn the telly off, have a chat about you and your family. Talk about you, proprietor, what you can do. So have some focus. And if you don't focus on the initial stages, you're not going to focus from the get-go. Now, Jackson will say you have that chat on Messenger, but I don't know about you, but chatting on Messenger just does my head in. So I'm just going to say, just cut to the chase and just have a chat. Is that all right, mate?
That's it, mate. That's it. Whatever works for you. We're here to support.
All right. So we'll get the links. We'll pop them in there. Darren, is there anything you'd like to wrap up with asking the great man about our buckets? Not kicking the bucket, but building the bucket.
Well, it allows you to have great lifestyle before you kick the bucket, doesn't it? So, no, fantastic. I think every fortnight we're getting deeper and deeper into some structure and implementation. So fantastic. Thank you, Jackson.
Happy to support, guys.
Absolutely outstanding. Well, guys, what are you going to do? It's the doing, not talking about it, that makes the difference. Have a decision in here, take some massive action. Click the links, have a look into the video, or just go straight to a discovery call. That's what I'd recommend. I think you've heard enough today. And speak to Jackson or one of his team members who are outstanding. They're top of the game. Jackson, thanks so much for your time, mate. It's always an absolute delight. We learn so much. It's so valuable. I know how busy you are. People helping all the time and always want the great man. So I really appreciate your time, mate. Fantastic.
Happy to help. Happy to support.
Terrific. All right, gang. Hope you had that pen out. Write that stuff down. Click the button and actually have a chat with Jackson and his team. Or if you want to listen to the videos, do both. But take some massive action. Don't think about it. Just do it. And it's only going to be a conversation. And everything starts in your life with a decision to say hello. So say hello to Jackson and the crew. Take some massive action. We'll talk to you when you're a little bit older, not longer. Bye for now.